Your savings account pays 4%, prices go up 3%. You did not get 4% richer, you got about 1% richer. That gap between the rate quoted on paper and what your money actually buys is what the Fisher equation is for. Irving Fisher wrote it down cleanly in 1907 and developed it fully in 1930. The exact identity, 1 plus the nominal interest rate equals 1 plus the real rate, times 1 plus expected inflation. A 3% real return on top of 2% inflation gives a nominal yield of 5.06%. The cross-term r times pi makes the multiplicative form slightly bigger than simple addition. For low inflation, the cross-term is tiny. Drop it, and you get the form everyone actually uses. Nominal I is approximately real r plus expected pi. 3 plus 2 is 5. The approximation is excellent below 10% inflation, and bad above. Rearrange and the real rate falls out. R equals I minus expected pi. This is the rate that matters. Your savings account, your mortgage, every investment decision, they all care about R, not the headline number quoted in the contract. The Fisher effect is the long-run prediction. Raise expected inflation by 1 percentage point, and nominal rates should rise by exactly 1 percentage point. The real rate stays put. Watch, inflation drifts up from 2 to 4 to 6, and nominal rates follow in lockstep. Co-integration tests on U.S. data since the 1950s find the slope close to 1 over multi-decade horizons. Markets, price expected inflation in real time. A standard 10-year Treasury yields the nominal I, a 10-year TIPS, a Treasury inflation-protected security, yields the real R. Their difference, called the break-even, is what the marginal investor must expect inflation to be. 4.2 1.8 gives a 2.4% break-even. The Fed watches this number daily. Throughout the 2010s and into the 2020s, this gap went the other way. Central banks held nominal rates near zero while inflation kept running. Ex-post real rates turned negative. Savings literally lost purchasing power. In 2022, U.S. one-year real rates fell to about negative 7% before the Fed tightened. The textbook test case is the U.S. Great Inflation of the 1970s. CPI inflation rose from 1.6% in 1965 to 13.5% in 1980. The 10-year Treasury yield rose right along with it, from 4.3 to 13.9. The two lines move in lockstep. The Fisher effect. On display. And there's one place this decomposition matters more than anywhere else: public debt. The debt-to-GDP ratio evolves as R minus G times the existing debt minus the primary surplus. If the real interest rate R sits below the real growth rate G, debt erodes automatically. America rolled World War II debt down from over 100% of GDP through exactly this mechanism. Fisher's identity is what lets you translate observed nominal yields into the R that goes in. One identity: bond markets, mortgage decisions, central bank policy, sovereign debt sustainability. All of it sits on top of nominal equals real plus expected inflation. Irving Fisher wrote it down in 1907. Still bedrock.